You have the budgeting apps downloaded. You have automated your savings. Your emergency fund sits safely in a high-yield account. You are doing everything the internet tells you is smart, yet you still feel like you are merely treading water. You possess a collection of financial hacks, not a coherent strategy. This creates a quiet, persistent anxiety. You are over-optimizing the small things while missing the foundation. The modern financial landscape is filled with noise. It is time to dismantle the illusions. The story everyone tells, buying a broad index fund means you can put your money on autopilot. You are told to ignore the market for 30 years and automatically win. That story belongs to a different era. It worked flawlessly during a decade of zero interest rates and smooth economic expansion. The reality of today is vastly different. The modern market is historically top-heavy. A handful of mega-cap tech stocks drive the entire index. Pure passive presence is no longer enough. You do not need to day trade, but you do need active awareness. Blindly trusting the autopilot creates a false sense of security. You must understand what your index actually holds. Otherwise, you are accidentally overexposed to a single sector's inevitable correction. The prevailing wisdom: parking your cash in a 5% high-yield savings account is the ultimate risk-free strategy. It feels safe. The numbers go up slowly, predictably, and without stress. That feeling is an illusion. Yields are cyclical, not permanent. As interest rates ease, those attractive yields evaporate. This exposes you to reinvestment risk. That is the painful reality of having to deploy your cash back into the market at lower rates. It usually happens right after you miss a major rally. Cash is a tool for short-term liquidity. It is never a substitute for long-term growth. Equating temporary yield with structural wealth leaves you stranded when the macroeconomic weather changes. The myth we accept: owning 10 different mutual funds, 3 ETFs, and a handful of individual stocks means your portfolio is protected. You look at your dashboard and see a long list of ticker symbols. You feel diversified. The reality is hidden in the prospectuses. Most popular retail funds overlap heavily. You might own 10 different funds that all share the exact same top 10 holdings. This is not diversification. It is expensive duplication. True diversification is not about the number of funds you own. It is about holding assets that behave differently from one another under economic stress. Holding 10 versions of the exact same risk profile offers zero protection. The instinctual belief: a sudden drop in your portfolio's value means your strategy is failing. The red numbers appear on your screen, your pulse quickens. You assume you made a mistake and need to fix it immediately. That assumption destroys wealth. Volatility is the normal, temporary breathing of the market. It is a feature, not a bug. Permanent capital loss is entirely different. That happens when you panic and sell during the volatility. Equating volatility with risk causes investors to abandon sound, long-term strategies at the exact wrong moment. Volatility is simply the emotional toll you pay for the magic of compounding. You must learn to sit quietly through the storm. The cautious approach: it is safer to hold on to your cash and wait. You tell yourself you will invest when the market cools down or when a looming recession officially clears. You want to time your entry perfectly. The data proves this is a trap. The best and worst trading days almost always happen within hours of each other. They often occur during periods of peak negative news. Missing just the 10 best days of a decade can literally cut your long-term returns in half. Trying to outsmart the market's timeline is mathematically futile. Time in the market is the only reliable, controllable metric you have. Delaying deployment in the name of safety is the most expensive mistake you can make. The modern financial obsession: wealth is built by tracking every single latte on a budgeting app. You spend hours maximizing credit card points and obsessively checking daily account balances. You feel productive. The truth is much harsher. This is the optimization illusion. It creates a flurry of administrative motion, but zero actual financial progress. True wealth is built through heavy lifting, structural decisions. It comes from dramatically increasing your savings rate. It comes from tax-efficient account routing. It comes from consistent asset acquisition, Micromanaging spreadsheet cells drains your energy. You must focus on the engine, not the paint job. The ultimate truth: building lasting wealth does not require exhaustion. It requires clarity. You must step away from the endless cycle of financial hacks. You must stop reacting to the daily noise. True financial freedom is quiet. It is built on a foundation of structural, deliberate choices. You understand the risks. You embrace the volatility. You deploy your capital with intention. You no longer chase the illusion of the perfect portfolio. Instead, you build a resilient one. That is how you stop treading water. That is how you finally move forward.